Well, hello everybody, and welcome back to another edition of the Forex Market Preview. My name is Jason Stapleton, and if this is the first time you're joining me, thank you so very much. And if you're one of the 56,000, almost 57,000 people who get this via email every single week or who have subscribed to the YouTube page, I really appreciate you guys as well. And today I thought what we'd do is cover just very quickly some ideas about how to incorporate higher time frame and trading time frame. And one of the things that we try and teach traders is to look at and to base trading decisions off of two different time frames. In some of the course material that we teach and some of the things that I've taught in free trainings in the past, one of the things I try and do is show how you can look at a higher time frame chart to judge trend and potential turning points, and then move down to a trading time frame in order to assess where to make an entry. And this is a very, very common strategy. This is not something that we invented or anything like that. It's just a lot of, and truthfully, a lot of what we do is basically taking concepts that are readily available and making them understandable and easy to what I call make them testable, verifiable, and repeatable. So give you a framework or a format to using those particular strategies in a way that's going to help you understand both how they work and also how to develop a trading strategy that eliminates or mitigates the majority of subjectivity in your trading. And this one's no different. One of the very first things that I do in the courses that I have taught in the past is the first thing we do is we strip away everything off of the chart. And so you see I have an RSI on the chart, which I use for other types of decision making, but there's nothing else on the chart. And the idea, of course, is that if we can strip everything away and we can get back to the fundamentals of technical analysis, they are simply the chart. Where's the market most recently to structure? Are we bullish or bearish? How do we determine that? All of these are questions that have to be answered in order for us to be competent technicians. And it is amazing to me how many people that I see who have been trading for 3 months, 6 months, a year, 2 years, 5 years, and they still, when you talk to them, they don't clearly understand or haven't clearly defined for themselves what constitutes bullish or bearish. And they'll give you some nuanced answer like, well, it depends on what time frame you're on, and da-da-da-da-da-da. And all that's fine and well and good, but it's like, okay, well, explain it to me then according to the way you do it. Because, let's say, is bullish or bearish based on the higher time frame or the trading time frame? Well, that can be done either way. You can do it either off of the trading time frame or the higher time frame, where you can say, hey, the trading time frame is bullish, but the overall market on the higher time frame is bearish. What you have to do is you have to figure out and define for yourself inside of this, how am I going to analyze the market? And consistency, I have found, is really the most important thing. When I developed a CTS strategy, which is nothing more than taking specific structural and sometimes patterns and combining them together, is to simply look at the market and say, how do I make sure that I'm analyzing the market the same way every single time? And I came up with this scoring mechanism, and it was designed for my benefit, not for a training benefit, because I developed it before I ever started teaching anyone. And the goal was just simply to find a way to make sure that every time I analyzed the market, I did it the same way. And so when you start talking about some of this stuff, it's important that you have a frame of reference. And we have talked about this many times. I have discussed it in multiple different live trainings and week-long trainings that we've done, all of that stuff for free. You can find some of that stuff at Trade Empowered if you want to go over there. The Into the Gray training that we did was I think people found really powerful. It's not a full week training, but it's about 2 hours. And then you've got the 2618 training, which will teach you a strategy based on some simple Fibonacci work and structure analysis. So there's lots of different things that you can use. It's free stuff to begin to build on. And the idea is that we introduce you to this stuff and you get some exposure to it before you have to spend any money. I'm not here to pick your pockets clean. I'm here to help you understand the markets a little bit better. And that's why we put out so much free information. But what I want to talk about today is somewhat jumping over the discussion about new structure high, new structure low, bullish and bearish, and just simply talk a little bit about some structure analysis and how you can incorporate higher time frame and trading time frame. And this will be probably more beneficial to those of you who have been with me for a long time, but nonetheless, hopefully a benefit to all of you who are listening today. But what I want you to look at here initially is just how the market moves. And if we take a look at some of the structure moves that have happened here, this is a really clear one to see. It's a big, long leg, boom, from swing high to swing low. And if I look left, I can see this shelf right here that the market violated. Right, so the market came in, we found a little support level, and if we look left, a little further, you're going to see that previous support level was previous resistance. So that support level comes back down in, resistance, the market holds there, we rally back up, and then this market gets a long rollover and we violate previous structure. We actually violate this level, and we violate this one, and we violate this one here, and we violate this one. So lots of different structure violations here, giving us somewhat of a clean slate. Now there's a lot of different stuff that can happen now that we've done this. This is technically an anchor leg because it is a break of structure. And so with this anchor leg, we can have some advanced pattern formations that form up here. We can also base it purely off of structure and what happens there, and take a look at it just purely on the structure. But clearly here, this is a break in trend, and the market appears to now be shifting into a bearish move. Market then rallies back up. We rally back up almost into this previous structure level, not quite. Would have been really nice if it had run all the way up there because it would have given us a selling opportunity, but that didn't happen. And then we come back down, and then we rally up, boom, we explode up here. And yes, I know there's a pattern formation in here. Many of you guys are looking at it going, Jason, is there a pattern formation here? I believe that there is. Let me just check. I may be wrong on the ratios here. Did we get a 618 on the second one? The second leg? We did, yeah. So we've got a bat pattern here that should terminate in an 886, and does it. Didn't quite hit the 886. If you front run your orders, you might have got it, but that was basically where we look for the market to terminate here. And we didn't quite get there, but none of that is really all that important for today's lesson. I feel the need to point it out because we do talk about advanced patterns, and I know many of you are really into those. Well, we come up here into this swing high level, close to a pattern formation completion, and then the market pulls back. Now, there's a couple of different things that we can look at here. We can look at this previous structure level, which would be the primary that we would look for the market to come down into. But we also have this previous structure level back here, this inside support level here. And if we kind of drag this out, you're going to see that we were kind of right into that zone. So we can see as the market is pulling back into here, we've got about a 50% retracement on the RSI. A decent opportunity here that since this market is now back bullish because we violated structure right here, that we may get a pop off of this. But this is all like broad overview market stuff because we're looking at the trading time frame, and we would never place a trade simply off of looking at our trading time frame, at least not according to the way that I would teach you to do it. What I would teach you is, hey, let's jump down to a trading time frame, something that's a little bit lower time frame. We're on the daily right now, so let's bump down to the hourly time frame and let's take a look at what we've got here. And as you look around, you can see that, oh, dadgummit, I'm going to lose all of that now. Oh well, you guys get the picture. We come down here to the trading time frame. And you guys can see the market came off the highs there. We kind of trickled down, and we continued to make new structure lows. And this is kind of ugly, but let me kind of draw it in for you here. Retracement back up, then we come back down, we retest support, and then we come in and have a lower high, and then we really retest support again, but we get this nice little break of structure right here, and then the market finally, once we get back over here, boom, breaks down. Then we rally back up. Where do we rally back up into? Look left, structure leaves clues. Boom, right there into that structure level. Let me fatten this up a little bit. I'm using a new headset, and it's not quite sure whether I like it or not. But so we come back up in here, previous structure right here. Previous structure support becomes resistance. And then the market comes back down, and we put in a double bottom. Now, we know that we've kind of double bottomed. If I kind of draw this in back out on the daily time frame, you're going to see that we've kind of double bottomed right in here, almost right up against that little interior structure level. Now, does that mean that we ought to take a trade? I don't know. It really depends on your rules. But what I want you to pay attention to is realizing that if the market will make a break of structure here, and this is the way that I would teach you guys to do it. I like to wait around till the money's laying on the ground, begging to be picked up. And so we get all this, we get this nice downward move, but you'll notice, guys, that we've never had a higher high. We've never had a point where the market wanted or showed us that it was going to break out into new structure highs. And so that didn't happen, or it hasn't happened yet, but we've given kind of a signal here because we've violated, and really we have violated because the highest right here. So we've got a new structure high here. Now market's pulling back down into previous structure. So the idea here is there a potential trading opportunity here? Well, there potentially is. There's a 2618 trade. There's a potential way to capture a sell if the market goes higher, right? So if the market goes higher, we can grab our Fibonacci extension tool. It's not a perfect scenario here. We really need the market to break out a little more. 1618. So we can get a rally here, boom, up into the 1618, and then we can look to sell on a relief rally. We can wait for the market to come down a little bit, and we can buy them up here and look for the market to rally. There's all kinds of different things that we can do around this little area. But it's because we can look at our higher time frame chart and say, yes, I've got some structure there that I can play with. Yes, there is a higher probability that the market may turn here based on what I have seen on my higher time frame. And so I wanted to point this out to you guys today. I thought a lot about looking at and teaching a psychology lesson today on some stuff that we did earlier in this week in the syndicate. We had a couple of trades that I was, that were, one of them we waited for forever. It was the euro pound trade. I put this sucker on, and we got this really strong rally. Boom, right off, we entered here, market ran all the way up, and then boom, here we entered on Friday here, and then the market just rolled over, almost pulled us back to our break even, where our stops are here at break even. And that was a little frustrating, but I put on another trade that same day, and that trade is right here, and we entered right here, boom, and the market literally from our entry, well, it wasn't, our entry was here, but we had a little bit of pain in here, not hardly anything at all, and then boom, the market shot up like a rocket over 100 pips and added 100 pips to the end of the week. That was a really nice move. The bad thing was our euro pound trade went the other direction. And so there's a psychology lesson in here on, number one, taking trades when they occur, because the euro pound and the pound dollar trade were almost hedges against one another, because the pound dollar trade was bullish and the euro pound trade was bearish. And so we were basically banking on the euro both decreasing against the euro and increasing against the dollar, which is not out of the realm of possibility, but these have been heavily correlated here over the short term. And so it really was more of a hedged trade that we put on. And I talked with the guys in the syndicate a little bit about it and just said, look, maybe it rolls over. We roll our stops to break even. We've got them in place, and that way we're not going to lose any money. But we for sure don't want to give up on other opportunities. And it's a really good thing that we did. And there's a lesson in here about following rules and continuing to take every trade regardless of what the last 2 or 3 trades did, because you never know what trade is going to make up for the losses. We had 1 week a couple of weeks ago where it just felt like everything was going wrong, and then we just continued to trade, and then wouldn't you know it, I think it was a Euro Aussie trade or something, ended up banging out 300 pips in like a day and a half, and it made up for all of those losses, put us into the money, and ended up being a really nice trading week by the end of the week. Well, those type of things don't ever happen if you stop trading. If you just say to yourself, well, things haven't been going well, I just can't stand to look at my charts anymore, so I need to go away, and I need to walk away. The only time I ever suggest someone do that is when they know that they are so emotionally unbalanced that there is no possible way they could follow their rules. Because if you have done everything correctly, if you have developed a trading plan and written out your trading rules, if you have tested those rules historically and you have found them to be profitable, If you have then gone out in real time in your demo account and you have tested that strategy in real time to make sure that you can do in real time what you did historically, and you have found that to be the case, well then guys, what you need to do every day is come into the market and trade with discipline and trade the plan. And so the only time that you should deviate from that plan is, number one, if you find that historically you're exceeding your maximum drawdown, your maximum number of losing trades, because that may be a psychology issue, or it may very well be that your particular trading model has not adjusted as market conditions have adjusted. As volatility has expanded or contracted, depending on the rules that you've written, you can have a variety of issues that come up with that. But more importantly, what I found to be the case 99% of the time, not the 1%, the 1%'s the other one, but 99% of the time is a guy just doesn't follow the rules. And so what I would tell you is the only reason to stop trading, when you've done all of that work, the only reason to stop is if you know that you are so on tilt that there's no possible way you could follow your rules. But that's another lesson for another day, I guess, because I decided not to get into that because I didn't want it. I don't like to look back. I want to look forward, and I want to show people what the potentials are for their trading week. And so as we take a look here at Euro USD, we've got a double bottom here, almost a break of structure. Haven't quite been able to get over this last little spike high. If we can get over that, we've got a potential 26.18 trade here. And if we come back out to the daily time frame, what you're going to see, gang, is that buy on that 26.18 will be in the direction of the underlying trend. Why? Because the underlying trend right now on our higher time frame is bullish. So anyway, I don't know if that's helpful or not. I just it's been one crazy week. I've had 2 kids vomiting up a storm. It has been I've had to leave the office at noon every single day this week. Next week I've got to go to Washington D.C. So it's just been an absolute nightmare of a week, and this is the start of a new week. So I'm going to do everything I can this week to try and not make it like last week. But I just in my ability, what I'm saying is my ability to prepare for the lesson today was not where it normally is. But what I would ask you to do is over the next week, start looking at taking 2 different time frames. And it doesn't have to be the hourly and the daily. It can be the weekly and the daily. It can be the hourly and the 15-minute or the hourly and the 5-minute chart. It can be a 15-minute chart and an 89 tick chart or 5 range or something like that. Well, you don't really want to go to range chart, but you get the picture. You can break it up however you want to. You just want to make sure that you're using a higher time frame to determine underlying trend and then trying to find key places where the market is likely to reverse or is likely to continue in trend. And then drop down onto that trading time frame and employ a lot of the structure analysis stuff that we have been talking about since I started doing this video. Well, good grief, 2010? I think the Facebook page, the YouTube page was started in 2009. Doing in 2010. It's the same stuff, guys. It doesn't change. It's kind of funny if you do the right things. You know, the right things to do are the right things to do. Whether it was this year or last year or 50 years ago, or whether you go all the way back to the 1930s and you start talking about Gartley, whether you go back to the mid 90s and you start talking about Pesavento. All of that stuff. It doesn't change. It's as relevant today as it ever was. So do a little bit of time, do a little bit of research, start seeing if this makes sense inside of your trading plan. If you'll do all of that, I'll be back next week. Until then, guys, good luck, good trading. I'll talk to you then.